Today, we are going to talk about the new stay-at-home economy. This is a term that we coined at the Wyckoff Market discussions, which we hold on Wednesdays, and we hold them live and discuss current market situations. Well, the current environment is so unprecedented that I'd like to start the session with a rant, something that we do often in the Wyckoff market discussions. Let me begin by reading from a recent strategist report from Liz Ann Saunders, the great market strategist for Charles Schwab. Several Wall Street firms' economics departments have started publishing estimates for next month's payrolls, with estimates as dire as an additional loss of nearly 28 million jobs, and that's just for April. Strategist Research Partners highlighted the economic path. After the great financial crisis, U.S. payrolls bottomed at around 130 million. Payrolls peaked in February of 2020 at 152.5 million. If the recent pattern holds and claims continue to be similarly dire, we are about 2 weeks away from erasing all the jobs gained in the past decade. All the jobs gained in the past decade, meaning going back to 130 million jobs. U.S. real domestic product was at about 15 trillion in 2010 and was set to be about 22 trillion in 2020 before the shutdown. That means a difference of roughly minus 30% if we erase the decade. So then Liz Ann Saunders goes on to list the GDP estimates from some of the big important research houses, and I won't go through them all. I'm looking at them here, and they're quite stunning. The Wells Fargo, which is right in the middle, minus 14.7. This is for the second quarter, the quarter that we are now in, on an annualized basis. So this would be annualizing the second quarter. Bank of America Merrill Lynch is at minus 30%. And Goldman Sachs is at minus 34%, with Evercore ISI having the highest decline GDP estimate of minus 50%. And of course, nobody knows what the actual numbers are going to be because this has been so fast and so shocking. But the point being that we need to open up the economy. And so, and I'm speaking for myself here because I'm one of these people that is in the high risk group. That's me right here. You can see, and I want you to know that I was smiling in that picture. And so we, just like in Sweden opened up their economy and they said, you know, people, citizens, you know, take responsibility for the safety factors that you need to employ in your life. And we are at the point where we really need to do that, because if we have the kind of decline that is being suggested by these numbers going back to 130 million payroll, and then we have no idea how difficult it's going to be to kickstart the economy after this. But, you know, many of us, me, have the feeling that it's going to be slow. It's going to be a slow recovery. And so we really want to get our people back to work. And so keeping that in mind, there is something else I want to talk about the Russell here for just a minute. And I want to read you this prior to that. A recent study has been making the rounds by Wampley and AARP showing that more than half of small businesses cannot survive a 3-month shutdown, while more than half of households have no emergency savings. The lasting emotional hit of the economic shutdown is likely to usher in a more frugal consumer, one that is more biased towards savings over consumption. Another reason to be skeptical of a full-blown V-shaped recovery. Also today, James Gorman, the CEO of Morgan Stanley, made comments on CNBC following their earnings report. And he basically, among the comments he made, he said GDP could fall 30% in Q2, similar to the numbers that we just looked at. He does not expect a V-shaped recovery. We'll talk a little more about that. And that he says a good thing, banks are not remotely close to being short on capital. Very, very important. So let's now thinking about, this is the big existential threat, is small business. Small business is so important, I'm sure, not only in the United States, but in the world, because small business is the engine of job creation. It is where great ideas are created. Large businesses don't grow employment. Large businesses tend to contract employment. They're always downsizing and reducing employment numbers. Small business is where the growth is. It's where the innovation is. We need to protect our small business. The sooner that we get reopened, the sooner that small businesses are going to be able to try to piece it back together. I have many friends that are small business owners, and I can say from my discussions with them that it's a very difficult environment, and they really feel as though they're risking it all at this time. So I don't have a lot of time for this, but let's just go here. And I want to show you this. We have looked at this chart repeatedly in the past. I still have hope that we could have something similar to this happen in the first half of the year. And of course, we know that the decline was much deeper than this, and that we've had our automatic reaction low, and the buying climax is up here. And now I believe that we are in the process of building this area, and that we've had a rally, and the rally that we've had has been a rally in a vacuum of news. This rally that we've had off of the climactic lows, the automatic reaction lows, has come in the absence of economic data. It's come in the absence of earnings. It's the classic time to be able to put the market up and be able to do it on the vacuum of no news, no information that Wall Street can act on. And there is zero guidance that's going to come out in the second quarter. Companies are going to announce earnings, and they're not going to have guidance about the future. And Wall Street hates it when they don't have clarity and guidance and visibility of future conditions. And we're not going to have that for a long, long time. So I think, and this is as Liz Ann Saunders has implied, and also, or outright said, and same with Mr. Gorman at Morgan Stanley, is that it's not likely to be a V recovery. Well, what kind of a recovery would it be? I think this is the most bullish scenario here, and it may be that we have to go all the way through 2020 before we get to a place where we can complete a base for a good move up. But remember, good uptrends have good bases. Recall that the composite operator wants to buy in the bottom half of the accumulation range. So they aren't interested in buying in the top of the range. And so they will, I believe, be very patient and allow earnings reports to come out in the month of April. And these earnings reports are going to provide more evidence about the nature of the economy going forward. And I think that that uncertainty could give us a decline back towards the low. It doesn't have to get to the lows, it could get slightly through the lows, and this would be a spring. But if we can get to June, July and get to the third quarter, it could be very likely that we've completed an accumulation for an important move up, similar to the 1962 analog that we looked at in prior episodes. And so here we can see the case for accumulation. Now let's look at the Russell. The Russell is not small business. It's more medium-sized business, but it is going to be our litmus test for the current environment for small domestic companies. And so you can see here that we're in a small business Armageddon, and we need to do everything humanly possible to protect these small businesses, protect these owners, protect these workers that are in these businesses, because we simply cannot afford a 30% down second quarter in GDP. We just can't afford it. And the sooner that we get restarted, the better. And it's going to be up to people like me. I'm an OG, I'm an old guy. And so my risk levels are heightened. It's going to be up to me to protect myself so that I am not exposed to the risks of the COVID-19 viral infection. And so, and I'm doing everything I can, and all my friends are too, and that's something that we have to do for the sake of small business, so small business can get back to work. So here is the Russell as our benchmark. Notice where it is. This is, the Russell has been very, very weak, and you can see here that a relative strength downtrend has been in place since the middle of 2018. And this relative strength downtrend is immense. It shows that small to medium-sized businesses are underperforming dramatically, and the decline that came in small business here was breathtaking. And so with that, let's keep in mind that these people have to get their workers back to work, start to stabilize the employment situation, and give people some level of confidence that they have a paycheck and they're going to be able to have, they may work partial hours to begin with, but as the economy starts to recover in the second half of the year and in 2021, their employment is going to become more secure. Okay, so with that, let's move on and get into some of the more interesting stuff. This is the NASDAQ Composite, and it's a fascinating analog. This is 1994 to 2000, and this is 2015 to the present. And so what I'd like to do is I'd like to look at these two environments. And here you can see that there was a classic uptrending channel. This is called the reverse use of trend lines. It's a Wyckoff technique where instead of drawing an uptrend underneath the lows of an uptrend, you draw it over the peaks. And in this case, you can see this peak and this peak. Well, Wyckoff always said the stride of a market will be set very early in the uptrend. And so you can see here that's exactly the case in this example, going back to 1995 here, and then 1996. These are the anchor points. And notice how well, just drawing these back here, they helped to identify the trajectory of the NASDAQ comp. So about in the midpoint, 1998, there was a breakdown. And at that breakdown of the oversold line, excuse me, as a matter of fact, let me just take a break and clear my throat. Just an excuse to drink some coffee. So you can see that there was a breach of the channel here in the third quarter, end of the third quarter of 98. So keep all this in mind as we go forward and look at the current situation. And there was a dramatic rally that occurred after that, that took the market up dramatically into a hypodermic and a buying climax that completely took out, after riding along the reverse use of trend lines for 3/4 of a year, it went into a hypodermic move into a buying climax, and that was the end of the bull run. Very dramatic. And then this decline here down to the automatic reaction was a 37% decline. Okay, keeping that in mind, let's now go over here and look at the current situation. So 2016, important cause was built, a good low, and here's the 3 anchor points. And let's see if we can blow this up. So here's the 3 anchor points, the same reverse use of trend lines, sets the stride for the advance for the years to come. And so here's the reverse use, here's the oversold line. It's a parallel that's a dot. I always draw those as dotted lines. Another parallel is up here as the market went over the top of the reverse use and rode along that. Couldn't really get away from it. And then a very sharp decline, which took out the bottom of the channel in late 2018. So remember 1998, same thing happened in 1998, but it happened in October. Here it happened right at the end of the year. And so this rally took the NASDAQ comp back up to the buying climax, and it overthrew the buying climax and had an important acceleration type run where we documented the extreme psychology and sentiment and everything else that went with this buying climax, throw over, overbought condition. We talked about that, use other indexes, but they all kind of coincided there. And then after that, a very steep decline. And so we're calling this the automatic reaction, which is similar, and we'll go back and look at 2000. But this was a 32% drop. So actually the drop in 2000 was a steeper drop at 37% than the current one at minus 32. And then an important rally ensued after that. So we can see here that this little rally that went up and touched, it went slightly through the 39-week moving average and then touched this ascending trend line here, the blue dotted line, was where things stopped. And this was right at the beginning of earnings season in 2000. And then we had a reaction back down to a slightly lower low here. And this was into the completion of earnings season. So similar. Now, there's a couple other things I want to say about here is that we talked in the past about decennial patterns, and we'll do more on that in the future. But this is the 0 year of the decennial pattern. 2020 is the 0 year of the decennial pattern. So a commonality between the two analogs. Second thing is that it's a presidential election year in 2000, and it's a presidential election year in 2020. And so we have two really big correlations in addition to notice how closely this rally, two-stage rally, is related to this two-stage rally with 1998 and 2018 important lows below the channel, which created V bottoms and important rallies up. So now the next question becomes, what happens next? You can see that in this rally that we got up to September, last point of supply, and then completely failed out of the channel. Well, in this case, do we have a last point of supply? We've rallied up to the declining 39 here, which is a form of resistance, and we're very close to the uptrend channel right here. And we're into earnings for the second quarter, which are going to be very murky, going to be negative, and we're going to learn a lot about what the future holds from what comes out in these earnings during the month of April into May. And so this is going to be a very interesting environment, as it was in 2000. One big thing I want to talk about that is different about this environment is notice that in 2000, the relative strength completely collapsed. It went into a big hypodermic explosion of buying climax in the relative strength and then just failed horribly after that. And the NASDAQ, and there's a number of reasons I could talk all day about this, and I'm not going to do it. I want to show you some stocks. But here, notice this, interesting. The relative strength continues to make new highs. I think this is encouraging. And I believe that this could be where this analog shifts from the analog of 2000, is that if the relative strength can continue to hold here, it could very well be that we can build a good accumulation structure over time for a better move up. And so there's our analog. Now I want to show you what happened in 2000 after the completion of this. And so let's have a look. And here it is. You can see that this decline went all the way through the bottom of the channel, rallied up, touched the channel from underneath, kissed it once, and then this completes a big distribution. And this was a huge decline in the NASDAQ Composite stocks, down 78.4% top to bottom. So it was really just a wicked bear market that occurred from 2000 to 2002. Now, there was a number of other themes that did quite well, and that's the topic I want to talk about today, is to introduce the concept of themes that could be great for our future, a shopping list, so to speak, for us. And so you can see the relative strength too just underperformed for a very long time. Okay, so with that, let's just very quickly look at a point and figure chart. This is 5-minute data, goes back to the beginning of April here, and you can see that a cause was built and a rally ensued, and notice how well we went right up into the count, what could be the conclusion. Here I just took the same chart and I just updated it through the current data that I had, which shows that there's a drop occurring, a pause. Now, what would be constructive would be if we could basically hold this uptrend line or flirt with it and then make a higher high. But it appears that at least on an intraday trading basis that we've fulfilled this count. And this is just as earnings season is, getting really going. So this is a really small count in a very short time frame, but interesting. And I like to just keep looking at the intraday. Okay, so these are the cues. I'm not going to spend much time looking at this, but I thought it was an interesting chart. Maybe I'll throw this into a blog for you guys, but look at here, normal use of trend lines, or 2016, 3 points, and look at how it informs the advance all the way up. Here's the oversold condition in the NASDAQ 100, and then an overbought condition, buying climax, slight throw over the top of the channel, and then a complete failure. It's rallied up to the demand line here, very important trend line. This could be important resistance. So we would want to see if it can reverse back down and get below the 39. Okay, relative strength is still super good here. That's a great positive for the NASDAQ stocks. Now, let's spend some time talking in what we have left about the stay-at-home economy. So as you know, the restaurants, and these are all small businesses for the most part, are shuttered. They're shut down. They're you can maybe go to some of them and get takeout, certainly something that we're doing, trying to support them. But think of all of the dining that we all did in restaurants before the COVID-19 disaster. Well, we all now are accumulating our foods that we are buying primarily from markets, and so big and small. And this is likely to be our future as we stay at home, as we try to manage our budgets very tightly, and so on. Here's Weis Markets, which is out of the Northeast. Look at this beautiful big accumulation here. Climax comes down into a phase C low right here. It's a higher low. It springs these lows, but it doesn't get below the lowest low of 2017. It's a huge point and figure count. And so you can see that all of a sudden, Weis Markets is starting to really lift off. This is really a vibrant advance. And so it may have to pause, but if it can pause without giving up much ground and then going up again, this is going to be very constructive. Big count, big potential, and the relative strength is now looks as though it's trying to commit into an uptrend, which is leadership. So this is an example of markets. Here is United Natural Foods. This is more of a downsloping accumulation type structure. I'm really taken with, this is pretty speculative, but look at the volume here. And notice this big lift off, gets above the long-term moving average, only comes back halfway, and now it's trying to go up again. This could be a point and figure count, and it's really early here, but the relative strength, it's like green shoots. Relative strength is trying to turn up above a downtrending moving average, which has been downtrending for a long time. Probably a little premature, but one to watch, and fits into the theme of the stay-at-home economy. Here is Weis Markets point and figure. I got these a little out of order, but you can see here that we're around $44. And just this count, the yellow area counts 60 to 63. And so that puts us back up to the highs here. And then we have, if we can get there, we have a count that goes all the way across, much larger. Some potential here for Weis Markets, especially if it becomes important leadership. And then here's United Natural Foods. Here is that downtrending accumulation structure, and it counts up 42 to 45 and taking the whole count. But the other thing is, and this is important to Wyckoffans, is we look for distribution structures to be complete. And notice how this went all the way from the mid 50s here, low 50s, and gave a count down to $5. And it's exactly where it went. So this stock could still be in trouble and could spend a lot more time, but it certainly is interesting. And like I said, it's just something to watch. Probably too speculative, but interesting to watch. Sprouts Farmers Markets, another great retailer of foods. And here you can see that there's a climax going all the way back to 2015. Here it's been largely out of favor. Look at the relative strength throughout. And so you have support here, springs the lows at the conclusion of this long grinding decline, springs the lows, and then look at this big bar here as it comes back to the long-term moving average and comes back in to what could be a giant accumulation structure. And so here you can see also that the volume's expanding nicely as that happens. Change of character, somewhat of a question mark, but very constructive. And then look at how the relative strength is rising above its declining trend line, and it's above the moving average. And this suggests it wants to be leadership. Looking at the point and figure, and it's the last chart we're going to be able to do today, is the point and figure just of the yellow part of this goes 26 to 30 and then has a huge count for much higher prices. And then here, let's just put US food products on the chart here. Look at the relative strength. I'll just show you that as I say thank you for listening to my rant. Let's get the small businesses back to work, and thank you for listening, and we will see you next week where we will talk about more of the stay-at-home economy. Thank you all.